Hello, everybody, and welcome to my updates on not only my own picks, but also picks from a few others where I have commented in the past, I have written about in the past, talked about in the past, and I will start with those. For one, there is HireCar, and Hire reported earnings recently. I won't go into any specific details. I have written a Seeking Alpha article. That's why I'm commenting on them. I like where they're going. It seems with the AmeriDrive agreement, with this big deal, they are making good progress. And I think it will be quite successful next year. I also think there are a lot of risks associated with it. One of the most important ones, and probably the reason why the stock has not reacted in any positive way so far, is that they will probably need to raise more money. At least I'm having a hard time seeing them getting to break even on the current cash balance. And so that is not particularly good in the current environment. And the other thing I really do not like about HireCar is that we don't really have good access to management. I don't think anybody has good access to management, to be honest. It's just in their nature that they don't communicate that well, I would say. But otherwise, there is a lot of upside to this business model. And I think it could be a tremendous winner in 2023. But so far, I just have at the moment a very, very small position, just because I don't think we will see any really big things happening in the next couple of weeks and months. And I would really like to get this financing overhang removed. Then, speaking of financing, PFFP is a disaster. Almost everything has gone wrong that could have gone wrong. And just a quick recap. So they delayed reporting on their two internal programs, Worry and Tacrolimus. They have not delivered on any sort of other deal. The union agreement or the union option agreement with about niclosamide has gotten nowhere. They haven't gotten to an agreement how to proceed from here. So nothing has really worked. And of course, the company is running out of money, which has led them to do an extremely dilutive offering on Friday. And the stock has hit below $1, I think, after hours. The financing itself was done at 115, I think, but with half a warrant. And it's extremely dilutive. I think it's about 50 to 60% that gets added to the share count. And I mean, this is really, they are doing this raise at the bottom, literally at the bottom. And it's just really, really terrible. So the CEO, Glenn, has really done a terrible job in executing and communicating. What bugs me especially is that to the last day, they have waited until basically saying that Worry and Tac will be delayed, because the reasons they cite, like delays and trouble with the FDA and trouble in getting patients recruited, and I don't even know exactly all the details, but all those were obvious because these are open label studies, so this shouldn't have come as a surprise. Anyway, I don't really want to go into much more detail, except to say this is probably a good opportunity to take advantage of terrible sentiment and add a speculative position. I would strictly leave it as speculative. because we still have no confirmation at all that any sort of big deal is coming. To the contrary, it's not unlikely that they need to do a raise again at some point next year. But of course, on the other hand, the new data readouts for Worry and Tech will be in Q1 and Q2, and nothing of their attractiveness has gone away. Of course, they need to find the right partner for that, and that's another question mark. And if you don't think Glenn can execute on that, which there is a lot of reason to believe he can't, then you should stay away. But if you think they can somehow make this happen, then despite the dilution, the stock is a buy here, at least a speculative one. There is a lot of discontent about Glenn, not only with investors, but also the board of directors. And we will see what kind of consequences his failures will have. That's on TFFP. Dolphin, DLPN, they have reported earnings. They were not really good to me, certainly not inspiring, to the contrary. And they have again raised money in form of, I think, the ATM somewhat, and again issued convertible notes. And it's just, they have also done an acquisition, which I think they have probably overpaid for. But the point is, there's nothing really to be excited about right now. They have not proven, at least in my eyes, that even Dolphin 1.0 can really make money, to be honest. Now they will say, yeah, all the expensive, that's for Dolphin 2.0, and so on and so forth. But yeah, maybe, I don't know. I don't even know why I should believe that, to be honest. So there's just, for me, nothing too exciting right now. I'm not involved in the stock, and I don't think I will be involved in the next couple of weeks, months. Maybe if we see some really, really good traction on some of the better Dolphin 2.0 initiatives, maybe then. But so far, I don't see, for me, nothing to see there at the moment. And then the last name I want to touch on outside of my room is Permafix, Casey. I really like the company still. What we have waited for has not played out so far. So we have no news on Hanford yet, but we do expect it in Q1, probably January, maybe a little bit later. They reported numbers. They were not bad, not fantastic either, but I would say solid considering the circumstances. And there is a lot of evidence that the business is really picking up right now, not apart from Hanford. And based on that, at $4, the stock is absolutely a buy, 100%. I like it very much based on that alone. And it's also extremely likely that they will get at least some work for Hanford. And that is the additional upside that will really make this stock a huge success if that gets ever done. So yeah, very optimistic about Permafix, and I have a healthy position in that, and I think there's nothing, there's not a lot of downside right now at these prices. So that was it for stocks outside my room. Stocks in my room, I will start with HRBR. I am currently almost out. I think I might have a small position left. They have a new agreement with another airline, but we don't have any details on that yet. We know because they filed recently that they would delay the 10Q. And it's because there's a dispute with United, which is not particularly good. And we will just have to see how that plays out. Right now, I don't think there's a lot of downside, but I'm also not particularly excited. And there will certainly need to be more details on how the company proceeds from here and how this new agreement works out, what the details there are. And until then, I'm not hugely interested in the stock, to be honest. Verde Agritech has reported numbers which were very good. I am quite excited about this one in the next year. I have only a small position right now just because I find other stocks in my universe, which I will talk about next, more attractive and which I know just much better. But I really like Verde. I like the CEO. I like how they are executing. And I think it's a good diversification to almost any portfolio, probably, to get some exposure to fertilizers, to get exposure to Brazil. And I think based on right now, it's already, I would say on current numbers, it's reasonably priced, maybe probably fairly valued. But because they're going to expand quite a lot in the next couple of quarters and years, based on those numbers, it's tremendously cheap. Now they will need to execute on that, but to me, there is no reason to assume that they cannot execute on it based on historic performance. This is a name, I have said this quite often, that is trending. So currently it's trending down, and I would probably wait to add more until it has established the bottom again. And so overall, a name I really like a lot, but one where there are a lot of things that are just unknown, political situation or just the industry. It's just something I don't have that much detailed knowledge as some of my other picks. For example, Geodrill. Geodrill reported earnings, which were absolutely fantastic. There is no other way to describe it. They are breaking record after record after record. It's stupid cheap. It trades at something like 2 times EBITDA or so. And it's at one of its cheapest valuations almost ever. It trades at a big discount to peers. It trades at a discount to a more reasonable valuation going into an upcycle. And so if that discount were to close, you're looking at probably 2x. The problem is, how does that discount close? And I don't have a good answer to that. That's the issue. There are, of course, one thing that could always happen is that the company gets sold. And we know Harper is not, the CEO is not, he would actually enjoy that. He would welcome that. But I just don't see any acquirer right now. I don't see another company being interested or bidding to Geodrill, to be honest. And I don't have the impression from talking to management that anything like that is in any way imminent. So we will just have to participate in the company executing, which they are doing tremendously well. And yeah, the question is, when will the market rectify this extremely cheap valuation and I don't have a good answer, to be honest. The company is paying a dividend. The company has a buyback program, but they don't really buy back any stock. I don't think Harper is that into buybacks, and the typical argument is, yeah, the stock is already illiquid, and why make it even more illiquid? Which has a point, but I kind of disagree because, yeah, it's illiquid, but if you buy back just a little bit, it would help the price probably a lot, and don't not really make it that much more illiquid. So this is one of these issues you always run into with companies that have rather illiquid stocks and could potentially do buybacks, but don't because of illiquidity. It's just something I tend to really disagree with. But that is that. Now, what was interesting on the call is, so first of all, there is tremendous demand despite explorers getting pretty whacked and having trouble raising more money. That is all picked up by the majors and mid-tiers, and so Geodrill sees record demand still. All their expansions are going very well, especially Egypt, Chile, and so that is going very well. What was interesting is 2 points. They are raising prices by 15% or so, and that is in excess of their cost increases. So the company has a lot of pricing power. They also said on the call that next year will probably a year of moderate growth, so less than so far, to solidify and consolidate the position and making sure that margins are keeping up. However, I have talked to the company after the call, shortly afterwards, and it turns out that they are seeing so much demand and they could potentially be involved in certain projects that they will still keep the current growth rate or higher than anticipated growth rate into next year. I don't know, that is certainly not clear yet, so I don't want to say this is absolutely going to happen. It was more like they are in talks and conversations about additional opportunities that would basically keep the growth rate up. So we will see what is developing on that front. And yeah, it's a tremendously cheap stock in an upcycle, and I like it. I like the very low downside. I just don't know how and when the upside will materialize. All right. Then DimeCore, DMIFF. So they had a recent tender that was pretty good. Solid volumes, solid pricing, and they're making good progress, especially considering that they had continued to have and continue to have these power outages from Eskom. And there is good reason to believe that that progress will continue with every quarter now being better again. They will also receive the BV machine in Q1. And once that BV machine is there, then that is the key to really increase volumes quite a lot. And so I have talked about that in the past several times, and so won't go into much more detail there. Now, the issue is that there was a news release yesterday that I also put out on the platform, which basically, not from DimeCore, but from Eskom. It was not really a news release from Eskom, but was basically the news it that there would be stage 4 indefinitely. It's just another stage in the sort of escalation of power outages nationwide, and that would obviously be quite terrible news for DimeCore, because so far we have been in stage 2 and 3, I think. So that's obviously really bad. Now, however, I have today contacted Dean about that, the CEO, and as it turns out, and this would normally be content that I would share with elite subscribers way before making it public, but I feel like I need to say this, because otherwise what I said in the prior sentences would be a little bit misleading. So based on the update I received from Dean, they are about to close a deal with Eskom, which would basically label them as critical services. That means they are only subject to a maximum of 4 hours of outage once a day in the absolute worst case. And they would be extended to the same substation as the DBS Venetia mine. So I do not have all the details yet. I will get more details tomorrow when I speak to Dean. But and I won't go as far to claim that they will be in the same situation as DBS and Venetia, but being on the same substation sounds like really, really good to me. And it is noteworthy that usually what kills productivity is frequent and short outages, because the machines can break down, there can be real damage, it takes a while to start everything again, and so on and so forth. But if it's restricted to at worst once a day, that already makes it much more feasible to properly deal with it. And I would strongly assume that when he is writing, this is the worst case, it's not going to happen that often. So this is really fantastic news for DimeCore. I cannot emphasize this enough, to be honest. And if you couple that with the still very, very depressed share price and the prospect of increasing volumes, getting the BV, having been already profitable and most likely, in my opinion, staying profitable and being much, much more profitable next year, I think this is a very exciting time for DimeCore. And I think this is a very, very good opportunity right now. So that was all I had on DimeCore. Next, I would talk about SNIP Interactive, SNIPF. There is not a lot of news to share right now, so we did have a pre-announcement around LD Micro, and I would say, yeah, of course, I would recommend checking the recent LD Micro conference, because a lot of our names have presented there. So good to watch these presentations, including SNIP. But we had a pre-announcement for the current quarter, which showed extremely good revenue growth. The problem, if you want to call it that way, is that costs were also up and gross margins down, and that is just related to Gambit, right? Because they are basically putting every dollar generated in Gambit back into the business to quickly grow the number of users. And I think that is absolutely the correct strategy, because the company has a lot of spare cash, and so they are certainly not in a position needing to raise money. To the contrary, they are actually in a position to buy back stock, which I would strongly prefer actually at this price. But Atul, the CEO, wants to. So I don't think there has a formal decision been made so far, but Atul wants this dry powder because going into a sort of economic downturn, he thinks there could be opportunities for them to acquire other small companies that run into trouble and so are available for cheap prices. So he's an opportunistic acquirer and wants some dry powder for that. We will see what happens on that front, but yeah, revenue growth is really, really strong. So year over year was up 45%. And keep in mind that was Q3, by the way, and keep in mind that Q3 in 2021 was a massive quarter. I think back then revenues were up 150% or so. So those 45% are actually much better than they look like. And additionally, we know that revenues for Q4 will be up sequentially again. So the revenue growth here is really fantastically strong. And profitability, they are currently operating around break even. That's sort of by design. And as soon as Gambit reaches sort of escape velocity, what I would call it, then profitability should quickly follow. So this is one I'm just really, really excited about because you have Gambit, you have the core Snip business, you have, and each of those would easily justify upside to the current market capitalization. And then you have also Snip Media, which is being started right now and where we will get press releases probably in the next weeks, certainly in Q4, with first customers and first initiatives and so on. And as a reminder, we had Barley's invest at 20 cents in the beginning of the year, and currently the stock is around 11 cents or so. So Barley's, and we also know that Barley's wanted to acquire them in full. We also know, well, no, that's enough said on that. So yeah, whenever you have a large company invest in a tiny company at a premium, if you go back historically, what happens then? Usually good things are happening. So it's just one more safety net, I would say here. And it's really a company I'm very, very excited about what is going to happen in the next weeks, months, quarters, because this could really be a huge, huge winner. And they certainly also won't be affected in a big way by any economic weakness, because to the contrary, actually, these sort of loyalty programs are actually getting more attractive in these scenarios. And yeah, just recently we had another press release which said top 5 most valuable food brand company in the Fortune 250 extends relationship with Snip to European market. And I probably don't have to remind you that in Europe, the economic situation is not that easy at the moment, which exactly shows that, yep, even in an economic downturn, Snip can absolutely grow the business and be very, very successful. And with that, I will change over to my last name, which is Tech. The other one I am extremely excited about, and they have reported earnings for the second quarter in their fiscal 2023, which were, I wouldn't say fantastic, but really good. Really good because revenue growth was 34%. So pretty good, especially their annual recurring revenue is growing at a healthy clip. It was 66% up year over year. And that is really what sort of the most important bit. Now, the question is, why did they not raise guidance when they had some additional deals closed recently, even smaller deals? And the reason is just that they had some delays in professional services being executed. And that's the only reason. And those delays will catch up in the next quarter or quarters. So it's actually better than it looks like. And once again, we had gross margins above 90%, which is just really, really good. And on the negative side, we had expenses up a bit. And that's why losses were also higher than before, year over year and sequentially. And so there was an analyst on the call, and what I've seen on social media, basically saying, yeah, the stock is now up, and revenues are growing, and now they turn on the spending spigots again, and there's no operating leverage, and they can't make any money, and blah blah blah, and all that might seem correct based on that one quarter. But a few things to keep in mind. Yes, it would have been nice to see profitability being increased higher and more, and seeing less expense growth. But keep in mind that they still aim to reach, they haven't changed their guidance on when they reach profitability, which will be mid next year. They haven't changed any language about needing to raise money, which is no, they absolutely do not need to raise money to reach profitability. And they really went through some tough times with almost no increase in expenses at all. And considering inflation everywhere, salary pressure, and so on, to catch up on that and be an attractive employer is absolutely the right move in my eyes. And lastly, as it was detailed on the call, they have hired some people for a big supply chain project that they will talk about in the near future. Now, that is most likely, in my opinion, so that is obviously, I mean, those are great expenses to have, right? If they lead to a big project. And I would assume this is a contract with Facebook. So we will see when that will hit, how soon we will get a press release or some kind of news on that, how large it will be, how exactly it will look like. But I'm fairly confident that it will be quite material, and it will be another confirmation in the business model, in the technology, and it will most definitely lead to a raised guidance. I would, in general, recommend listening to the call, reading the transcript. There were a lot of details, and there were a lot of good questions as well. One detail that maybe is worth mentioning is they had an additional expense in terms of don't remember the exact expression right now, but it's basically payments they are making to HCL for the city deal, and that is amortized over a certain period of time, and it will level off. So those expenses will not increase, they will decrease. And it's important to remember that without HCL, that city deal would not have happened, right? So that's money well spent. And even Charlie said this on the call, the CFO, that even taking all those expenses into account, the contribution margin is still above 70%. So really, really good. They have a pipeline. In their pipeline, they have basically, despite closing new deals and growing revenue, they have kept the size of the pipeline. And as a reminder, in the pipeline, there is only year one of revenue, and it does not include all prospects. So they are very conservative in what they put into the pipeline. So based on that, I would assume that we will get some new deals, maybe smaller ones, maybe also one or two significantly larger ones in the near future. And overall, I am very, very happy with the progress they are making. I would highlight lastly that this is the first time they talked about two $100 million opportunities. The sort of base business in supply chain, taxes, etc., and then financial services. And for that kind of small company, two opportunities of that size is really, really good. Fantastic. And to me, the current weakness is a good opportunity to buy. There has been some weakness from RSUs vesting with automatic sales for taxes. And this is something that happens regularly. Usually when they report earnings, they obviously don't talk about that too publicly because they want to avoid being front run on that. But I can tell you that that was one reason for the weakness after earnings. And apart from that, there is not a lot more to say, I would think. So in summary, I am extremely excited about especially DimeCore, Snip, Tech at this current moment. I am also, those are really names I would strongly recommend you keeping really up with the news flow and making sure you have your desired allocation going forward.
Some or all the speakers may maintain positions in the securities discussed in this podcast. The views in this podcast expressed are those of the speakers, not Breakout Investors. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Neither Breakout Investors nor any of its affiliates makes any representation or warranty, express or implied, as to the accuracy or completeness of the statements or any information presented by this podcast and any liability, including in respect of direct, indirect, or consequential loss or damage, therefore is expressly disclaimed. No one on this podcast is an investment advisor. No one is providing investment advice. Before investing in any company's stock, you must do your own research. Thank you for listening.